Good morning, traders and investors. Roger Scott here, senior strategist of Wealth Press. It's Tuesday. It's April 4th. It's about 8:01 in the morning, and the market's going to gear up to open in less than an hour and a half. Now, as you can see here before the opening, Nasdaq is up 49 points. Nothing really crazy. Dow is up 29 points. And yesterday was a mixed day for the market. Now, before I really get into the analysis and all the good stuff that I always jump into, I want you guys to understand, seasonality-wise, last week was a very strong week. This week, when we looked at this week, Monday looked like an explosive day, and the rest of the week was like going down. Now, seasonality is not 100% perfect, but almost every sector was doing that. So I'm extra cautious of the market right now as a result of that. Also, it's a short week, so there's a lot of liquidity being lost. Options are over expensive. I'm being extra cautious. Now, folks, if you're in one of my services and you're not seeing as many trades or you're seeing me being selective, I'm not doing it because I have lack of trades. I'm doing it because I'm watching your back, okay? I'm trying to protect you. Because right now, going long gives us a lot of option premium that's very expensive. And there's a lot of uncertainty, so we got to be really cautious. We got to walk this line very, very carefully. Now, today we have factory orders and JOLTS, which is not a huge report, but we got Loretta Mester speaking, and the Fed's already piping their theme and saying, hey, with this oil production cut that happened with OPEC yesterday and caused the energy market to go up, which is not a surprise, by the way. They said they were going to do it. I wasn't expecting this much of a cut, but that's OPEC for you. It's a gang. I mean, what are you going to do? So the moral of the story is that with this oil production cut and energy prices higher, the Fed is now talking about possibly having inflation for a while longer, which is not good for stocks. Another major factor is the bond market. Look at the bond market. It's down 49 ticks. The bond market went up the last 4 days, and so did the stock market. When the bonds go up, right, it's less interest rates, smaller rate increases. But that looks to be behind us, and it looks like the reality is starting to set in. And as you could see here, we've been in this channel range for quite some time. I'm not expecting us to break out. There's absolutely no reason this would break out to the upside. It would be kind of interesting if it did, but I don't think it's going to happen, and I think we're going to continue moving lower. And if this moves lower, if bonds move lower, it increases the pressure on tech stocks and all those fun stocks that you guys have been making money on the last few days. So my point is, you got to be really careful right now, really, really careful. And I'll give you more analysis on this. So this is the number of stocks in the S&P 500 above the 50-day moving average. Look at the RSI. The RSI hardly ever comes up here. Let me just give you a longer period. Sometimes it does earlier, but look at where it is right now. It's already up here, which is not necessarily telling me we're going to come all the way down, but what it's telling me is we're right now really, really overbought. Really, really overbought. Now, this is the actual S&P 500 price level. Look at where we're at. You see this? So it looks to me like we're going to turn the corner and start coming down. There's absolutely no catalyst for this market to go higher at this point. So I wanted to point out there's several things that are making me really nervous about the upside on the stock market over the next few days, especially on a holiday week, which is why I'm being extra, extra cautious with you guys. I'm not doing it because there's no trades. There's plenty of trades. I'm doing it because I don't want you guys to get hurt. Now, on top of that, let's talk about the analysis. So 3 U.S. benchmark, and I'll talk about the Russell after I'm done with this. U.S. benchmark indices finished the regular session mixed yesterday. I told you technology was going to weaken out, and it did, because the other 2 sectors that should be moving with technology are not cooperating, and there's only so much fuel the chip sector can give you. We had weaker than expected U.S. factory orders. The data was not good. Tempered inflation concerns caused by OPEC's surprise plan to cut production. I don't think it was that much of a surprise. Energy stocks gained ground to lead gains among the S&P sectors as the price of crude oil rose over 6% to a 2.5-month high. No surprise here, after Saudi Arabia and OPEC producers agreed on Sunday to curtail production by another 1.16 million barrels per day. Health insurance stocks rallied on better than expected Medicare Advantage rates, and tech-heavy Nasdaq underperformed. They're blaming it all on Tesla, but I can assure you it wasn't all Tesla. It was the sector. Tesla doesn't have all that much market cap compared to all the FANG stocks like Netflix, Microsoft, and Google, and Alphabet, and Amazon. So it was the Nasdaq. I love how they like to blame one stock on everything. Maybe if it's Apple, Apple I can get it, but Tesla, come on, let's be real here. Data on Monday showed that U.S. manufacturing PMI fell 46.3% in March, weaker than expected, of 47.5, demonstrating steepest pace of contraction in 2 3/4 years. I don't know what the hell the market was rallying on yesterday, honestly. Manufacturing PMI stood at 49.2, weaker than expectation of 49.3. Manufacturing prices came in at 49.2, weaker than expectation of 51.2. The bottom line is, I'm not seeing that rosy rainbow and butterflies and crickets at the end of the rainbow. I'm just not. St. Louis Fed President Bullard said Monday that OPEC decision cut output was unexpected and acknowledged that an increase in oil prices could make the Federal Reserve's inflation-fighting job a little more difficult. You see what they're doing? They're now blaming it on OPEC. Blame it on Squirrely, Mr. AKA Squirrely Powell, because he should have taken action when Trump was still in the House, but he didn't do it. Anyways, meanwhile, I told you this was going to change. Now look, there's now a 60% chance of a 25% rate hike, only at 39. About a week and a half ago, this was at about 56, 57%, and this was actually below this level. So now things are changing, which means interest rate heaviness has begun. Interest rate heaviness is not good for stocks. Today, all eyes are focused on U.S. JOLTS job opening reports coming out in literally a couple hours. Economists forecast that the February job openings will be at 10.4 million compared to previous number of 10.824 million. Now, this report is not a massive report, but it still is an important report, and it'll edge a stone in the Fed's mind in what they're going to do and how they're going to react. Investors will likely focus on speeches from Cleveland Fed President Mesters and Lisa Cook for fresh clues on the outlook of rates. Europe, futures are up 0.45 this morning as investors continue to digest the impact of the surprise production cut from OPEC. This is meaningful. China closed higher as strength in artificial intelligence stocks countered weakness in other sectors. Also, some China chip maker stock extended gains into a sector consecutive sessions after the government launched a cybersecurity review of imports from Micron Technology. However, the index's gains were limited as elevated China tension continued to dent investor sentiment. China warned U.S. House Speaker Kevin McCarthy Tuesday not to repeat disastrous past mistakes and met Taiwan's president, saying it would not help regional peace and stability. No soup from them. In addition, a raft of recent weak manufacturing data raised concerns over a fast post-COVID rebound in China economy. That's something I was really concerned with too, because they were really posturing how they're getting out of it. And I was thinking, they were under the gun for quite a while, or under the blankets for a while with this COVID. It would kind of seem if they just, roared out of it. But, China's China. Japan closed higher, boosted by energy-related companies while tracking overnight gains of their U.S. peers. So we do have some news today. As I mentioned, the U.S. stock market looks a little overbought on the number of stocks on the momentum level. I wanted to show you the number of stocks trading above the 20-day moving average. Now, this is a very sensitive indicator, but boy, oh boy, this is like a momentum indicator. Look at where we're at right now. I just wanted to show you this. Look at that. That's like a swing trading indicator. That's like the highest level we've been at since right here. So I'm telling you, this market is really, really overbought. When you have so many stocks rallying so fast, it creates a little bit of a momentum channel. And I don't know. This is just too much. I mean, look, this is the highest. Let's see here. Wow. Whew. When we go to this level, we typically cool off. So I am looking for some downside, and this is another reason why I'm being so defensive this week, because seasonality and this saying the same thing at the same time, we got to be really, 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 really cautious. Another major factor, and this is something Wall Street is conveniently not talking about, is Russell 2000. Look at the Russell. The Russell was breaking out and holding on pretty good, but it hasn't really been moving all that much. Yesterday, it moved only 8 cents. It's not outperforming the market. It's opening a little higher today, but that's not here nor there. The market is very volatile and very choppy. So we got to be very, 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 very careful. Now, let me show you sectors that I'm really liking and sectors that I'm really hating right now. We haven't done this in a while, like 2 days, but let's take a look here. Technology, communication services still leading, but look at this. Industrial and consumer are knocking at their door. Knocking at their front or back door, whichever door, but industrial, consumer staples, basic materials. This is where I see the market going higher. Consumer discretionary, technology and communication services, No soup for them. Matter of fact, you know what? Let's look at momentum levels on not on the 20-day S&P. Let's look at it on technology. That would be fun. I haven't done that yet. Let's take a look. Not Infotech, but Infotech right here. Let's see how it's looking right now. Oops, right here. Oh boy, same thing. Look at that. See, I knew it without even looking at it. Look at the 20-day momentum levels. I mean, do you guys see what I'm seeing? This is why I'm being cautious. Now, when you add seasonality to this technicals, it's telling us that this market is overbought. And look at Infotech. It's really overbought. I mean, don't believe me. Just look at this graph. Look at this thing. This is the highest level we've seen in a year. In a year. Let's see, 2 years maybe? This is, wow. We may be at the highest momentum level. Wow, we haven't seen this level since 2020. Let me see something here. This is the COVID recovery right here. Wow, that's something. That is something. Let me just put this up here. That is crazy. I just realized that. I wasn't even planning on showing this till now, but look at that. We are at the highest post-COVID recovery level, or a bounce to the upside on technology. Now, do you want to buy technology at these levels? You'd be a nut job to do that right now. So, technology, communication services, no soup. Industrial, consumer staples, basic materials. Where's financials? Financials are still at the bottom, but you know what? The less we hear about financials, the better these things will take off. And I like right now, I like the energy a lot for obvious reasons. So I'm bullish energy, I'm bullish industrial, consumer staples, material, and I'm getting really bearish on technology, communication services. Matter of fact, let's look at communication services too. Let's see where they're at on a 20-day level. Oh, 96%, I see. Oh yeah, baby. Look at that. So look at this momentum level. This is 20-day stocks making 20-day highs, 20-day lows. Do you think we're overbought enough on tech? And do you guys see why I'm not issuing trades? Again, I wanted to show you this so you can understand exactly why I'm so nervous right now. Now, today is today's Tuesday, and then Tuesday I go through sectors, and let me show you what I'm seeing right now. Way overbought. Overdone, didn't take out the high. I see more upside on industrial. I see more upside on consumer staples. But again, the broad market can crap out on us, so we got to be careful. Utilities looks like it could be cooling off. I think it's had it already. Real estate looks like it might have had it. Financials actually are looking pretty good right now, and they're breaking out. I like financials right now. But as far as individual stocks, I like GE a lot right now. GE looks great. I mean, look at this chart. I mean, you just can't do wrong with this stock. Look at that. Just change the template here. I mean, this is a beauty, right? What a stock. Wait for pullbacks like this, shallow pullbacks. So GE looks really good. Power looks really good. Really good. Like really good. And to the downside, a couple of crappy stocks. Lincoln National. I mean, look at this stock. Look at how much it gained with the rally we just had. What do you think will happen when this market drops? Let's think about this. What kind of stock is this? Is this a bank? Life insurance. Yeah, life insurance right now with the economy turning, I don't know. And VFC, same thing. Look, Lincoln and VFC. And let's see if this is the same kind of thing. No, definitely consumer discretionary. Definitely on my downside list. So this, I'm bearish VFC, I'm bearish LNC, I'm bullish power, and I'm bullish GE. That's GE. So again, just to give you guys a review, look at the momentum levels in the short term. They're insane. They're like really insane. And as I said, on technology, it's the highest levels we've seen since the COVID recovery. Be very careful right now, especially with let me show you which sectors you got to be really careful with right now. Consumer discretionary, information technology, communication services. Be really careful right now because they are as overbought as they were during COVID. Plus, seasonality ain't looking all that pretty, and the S&P's getting to the top of the channel. Now, am I expecting a major corrective pressure? No. I just think markets need to cool off because they got too excited thinking that the Fed is not going to take action. Well, they probably are going to take action. The odds now of 0.25 are higher than nothing. And we're going to have a lot of Fed speaking, and this oil fiasco is not helping us either. Now, before I let you go, Lance, you guys know Lance Ippolito. He's red hot. He's been working on something behind the scenes for a while now, and it's finally ready for the grand reveal. It's a brand new option scanner. That's right. And what makes it different from anything he's developed before, it's its ability to show only the opportunity he's willing to consider trading. Don't you love that? In other words, it filters out everything that's not worth time or money. And now Lance is watching opportunities in First Republic, Mattel, Google, Tesla, just to give you a handful of stocks. Lance is going to go live today, show you how the scanner works, and maybe even show you a couple of setups. I don't know. That's his business, but I wouldn't miss out. It's happening right after my VIP room. It's happening at 1 p.m. Eastern time today. I'll have a link for you there as well if you're there. Click the link below right now, below this video, or go to the YouTube Wealth Press channel, and it's there as well. Click the link, follow it, watch this class. You don't want to miss out. Sign up for it. It's going to be live. Now, I want you guys to subscribe to our Wealth Press YouTube channel. I want you guys to like that channel, and I want you to post comments for me there, and Uncle Roger will respond accordingly. Bye, guys. Have a great, great, great day today, and stay out of trouble. Again, my job is to show you what I'm seeing, and what I'm seeing ain't pretty right now.